Okay, picture this. Your bank calls you up, but it's not to pitch you a new credit card. Instead, they're actually calling to warn you that you're about to fall behind on your bills. They're predicting a cash flow crunch before you've even glanced at your calendar or, realized it yourself. Sounds totally like science fiction, right? Well, welcome to the new era of banking.
Look, this isn't some hypothetical maybe someday scenario. It's an operational reality happening right now. Today, major banks are using incredibly advanced artificial intelligence tools to predict financial distress up to 3 months before you ever actually miss an EMI or overdraw your account. They're looking at this massive web of data to literally foresee your financial future. So in today's explainer, we're going to break down exactly how these machine learning credit models score your health, what that actually means for your privacy, and how you can navigate this transparent digital surveillance.
Here's a super quick roadmap for our explainer today. We'll kick things off with the silent AI revolution. Look at how algorithms score your financial health, and then dive into the tricky issues of algorithmic bias and the black box. After that, we'll cover how banks are making these decisions transparent, and finally, lay out some proactive steps you can take to manage your digital footprint. All right, let's jump right into Section 1, the silent AI revolution, and how we're replacing the rigid rulebook. Moving right along to Section 2, predicting your financial distress and exactly how algorithms score your health. You know what banking used to be, right? For decades, old banking was super rigid. Getting a loan meant bringing in massive stocks of paperwork, waiting days, and then getting judged by just one thing, a static 3-digit credit score. It was just a snapshot in time. But AI banking? It's completely different. It's more like a living, breathing nervous system. Decisions are now powered by real-time behavioral data, transaction timing, and literally how you interact with your banking app. The AI doesn't just check what you earn anymore. It's constantly, instantly cross-referencing your tax records, your payslips, and your daily financial habits to build this continuous 360-degree view of your life. And the stuff these systems, like gradient boosting decision tree models, actually analyze, it'll definitely surprise you. It's not just about what you spend, but when you spend it. Did you buy expensive concert tickets the day before your rent was due? Yeah, the algorithm absolutely noticed that. It's looking for inconsistent salary credits, like if your paycheck arrived a couple of days late this month. It monitors how often you make small purchases, your overdraft frequency, cash flow behavior, balance trends, and even your device and location data. By putting all these surprising little habits together, the AI can flag that you're at risk of missing a payment weeks or even months in advance. Which brings us to Section 3, the bias and black box. Basically, what happens when the algorithm gets it wrong? Because, look, while AI is amazingly powerful, it's definitely not perfect. One massive risk we have to talk about is algorithmic bias. Now, AI models learn by looking at historical data. If that past data has biases baked into it, whether intentional or completely unintentional, the AI can inadvertently perpetuate and actually amplify those inequalities. And that leads directly to unfair customer profiling. For example, if a model is trained on old data where certain demographics were historically denied credit, the AI might just automatically associate them with higher risk today. It's this really blunt pattern matching problem that can result in discriminatory practices, even if a person's current finances are totally sound. And that highlights the dreaded black box problem. Think about it. Let's say you have irregular freelance income. That is a completely legitimate way to earn a living, right? But the rigid AI might just see irregularity and flag you as a default risk. Or maybe you suddenly spend a bunch on travel because of a family emergency, and boom, the AI misinterprets it and flags your account as a fraud ring. The absolute most frustrating part of this? When the AI rejects your loan or locks your card, you almost never get a plain language explanation. You're just stuck with, well, the algorithm said no. Let's look at how the industry is trying to fix that in Section 4, making AI decisions transparent with explainable AI. Regulators are actually stepping in because of this exact lack of clarity. Banks simply cannot hide behind a confusing, opaque algorithm anymore. Under the Equal Credit Opportunity Act here in the US, institutions literally have to provide applicants with specific reasons if a credit application is declined. And we're seeing this globally too, like with the European AI Act, which demands strict accountability, fairness, and governance. The message from regulators is pretty clear. If you are using AI to make big decisions about people's lives, you absolutely must be able to explain how you arrived at those decisions. So to actually pull this off, the financial industry is heavily leaning into something called explainable AI, or XAI. Basically, these are methodologies specifically designed to break that black box wide open. The whole goal is to make the decision-making process completely transparent and understandable. So instead of a simple yes or no, XAI lets the bank see exactly which specific data points triggered a flag. Maybe it was a sudden drop in your average balance or an unusual device login. This protects the bank legally, keeps regulators happy, and crucially, it makes sure you, the customer, are being treated fairly.
All right, Section 5, Managing Your Digital Footprint, how you can start taking back control. So, knowing that these intelligent algorithms are constantly watching, how do you handle this? The biggest takeaway here is that your daily digital behaviors matter just as much as your old school credit score. So let's talk concrete steps to clean up that footprint. First up, regularly monitor your linked bank accounts for any unusual activity. Second, try your absolute best to maintain consistent salary credits and avoid frequent overdrops at all costs. Those are massive red flags for predictive models. And third, really understand your data permissions. Know exactly what data you're sharing with your banking apps, and don't be afraid to exercise your rights when it comes to data anonymization. Finally, Section 6, Proactive Steps for Borrowers, or how to beat the algorithm when times get tough.
So, what should you do if you are genuinely struggling and you just know a missed payment is coming down the pipeline? Well, recent behavioral finance studies show that in the age of AI, silence is literally the costliest mistake you can make. Remember, the AI already knows you're struggling. Ignoring it is just going to tank your score. Instead, use this proactive playbook. Check your credit report like CBIL or Experian every 3 months. Pay really close attention to any AI-generated alerts or warning messages from your bank. If they're nudging you, you've already been flagged. And most importantly, self-report your financial difficulty to your lender early. By reaching out to negotiate a repayment pause or restructuring before you actually miss the payment, you keep massive negotiation power, and you can usually avoid a huge hit to your credit score.
So, what does this all mean for us? Ultimately, the future of banking is humans and AI working together, not one replacing the other. Don't get me wrong, AI is an absolutely incredible tool for predicting distress and processing insane amounts of data at lightning speed, but it lacks empathy. It completely misses the human context behind why a payment was missed in the first place. And that is exactly why human intervention, oversight, and ethical governance are still absolutely crucial in the financial sector.
Which leaves us with this final thought. Your AI bank manager is already here, and it knows your financial habits incredibly well. The real question is, are you ready to manage your financial footprint as closely as the AI manages you? Thanks so much for hanging out with me for this explainer. Stay curious, stay proactive, and I'll catch you in the next one.